Ladies and gentlemen, the tariff man opened his mouth. The markets are back on fire. Everything is going up, 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 and my portfolio is over $113,000 as it stands right now. But I want to tell you how I keep myself in check in these volatile times. If I'm gambling or am I truly investing? Let's jump right into this. Welcome back, my passive income investors alike. Today, I want to make a bit of a different video before I head off to the city because I got up this morning expecting the markets to be flat, and for some reason, Apple's up over 5%. All the markets are up, 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 and I just can't get over the insane volatility and how the markets work. Now, as the markets continue to go bigger and bigger, and there's more and more people getting involved, we notice the speculative aspects of the market become more volatile. Volatility comes from uncertainty, and people in the market like certainty, and because most people you're going to give your money to, including bank advisors, they usually trade. Mutual funds usually trade. The only companies that don't really trade are like Vanguard index funds that use really complicated algorithmic systems to keep everything in check and in balance. Most of us are stuck playing the emotional game of trying to figure out what is the best decision for our portfolios, which is why I've led down the complete path of only dividend investing. Dividend investing helps you mitigate, even though there are speculative risks, you have to understand that you're mitigating away from the short-term volatility aspect of the stock and you're focusing on the income that the business generates. This is why I became a dividend investor, because it helps you avoid the noise and focus on the bread and butter of the company. Now, if that changes in any way, obviously you're gonna have to pay attention, which is why when I watch people maybe like PPC or anybody else that has 40 stocks, I find that obviously they're gonna be doing it more passively and they're just trying to buy the stocks presuming that they're gonna be okay into the future, because there's no way I think you could actually keep up on 40 or 50 stocks. I'm not here to judge anybody's portfolio. I can only do what is right for me, and I think this is going to help you guys out a little bit as well. Now, when I'm looking at stocks to pick, obviously there's going to be your bread and butter winners, the ones you'll never have to worry about, the companies like the Starbucks of the world, the Apples. Like, there's just even though Apple is really volatile and people are terrified of that company right now for some reason. I don't know why, when they have $250 billion, let me repeat that, $250 billion on the balance sheet. It's pretty incredible. So buying that for dividends is fine. Just the problem is they don't increase dividends, and they're more apt to do share buybacks than they are do dividend increases, which is why I like focusing on companies that have higher dividend yield or higher dividend growth. But the problem with those companies is when you're looking into higher growth or higher yield, you're going to be looking into more speculative. Anytime I say the word speculative, you might as well just be using the word gambling. If you want to see how much people gamble, just join me on StockTwits. People doing short, long options, trying to figure out what's going on. Actually, the funniest thing I think I saw was when the markets killed earnings and all of a sudden Apple was hitting all-time highs. Everything was just going way up, and then Trump opened his mouth and said they're going to charge 10% on $300 billion in tariffs. All of a sudden, the markets just came crashing down, literally in the same heartbeat of the same day that the markets looked like they were going to be heading into all-time highs. It's crazy how we have no real control over this, and to think that we are smarter than anybody else is absolutely ignorant. We are no smarter. This is the reason that I got into this specifically, guys, and this is the reason I love this community so much, because it doesn't matter if you're worth millions or you're worth $100. We're all in the same bloody game. And honestly, if you want to be impressive, guys, just be patient and try and make the right decisions, and maybe you'll have the luck that I've had and other investors I have, like Financial Education, where you see your stock market portfolio making about an 18, maybe even a 10 to 15, 20% return. If you're getting those kind of returns consistently, people are going to shut up and listen to you. It doesn't matter whether they're worth billions, millions, or hundreds of thousands, or even $100, guys. You could only have a $5,000 portfolio, but if that portfolio is consistently outperforming everybody else, those fund managers are going to look at you and see what you're doing different than they are. It's so humbling to me in this aspect of this market, because I always thought that, you know, when you kind of come into this, you think the market's all about gambling, it's all about millionaires, it's all about the Wolf of Wall Street, it's all about Wall Street and Bay Street in Toronto here, just taking your money, ripping you off, blowing it on hookers and whatever. But that's not the reality of it. The reality of it is we're all just trying to look for freedom. Most people that get into this game aren't looking to buy objects, they're looking to buy time and freedom, and most millionaires kind of follow the same aspect. It's just something we do for fun because we enjoy owning and learning businesses and then getting paid for our time consistently in perpetuity, hopefully for the rest of our lives, so we can spend more time with our family and friends. It's honestly why we do it. Now, the way I honestly start keeping myself in check to figure out exactly if I'm gambling or not is how much my emotions are involved. Now, buying a stock like Tesla to me is 100% gamble. Don't kid yourself with what you're doing here. Tesla is one of the craziest growth companies of all time, but it's all based off future speculation. Obviously, today they're on a trajectory for it, but again, it's no different than watching a rocket blow up out of the sky. Nobody really prepares for that to happen, but it's happened hundreds and hundreds of times for as long as we keep sending rockets up and doing high-risk, volatile things. So when you buy companies where it's all speculative and it's all based on tomorrow's outlook, or 10 years from now outlook, there's a lot of discrepancies in between, because I'm sure when you've made a business plan, if you are like me and you've started God knows how many businesses over your lifetime experimenting with real world stuff, you'll see how many times something could seem amazing, and then because it's based on some future rules, future government laws, future aspect of whatever, all the stuff you work on today gets shut down by one stupid guideline or one stupid person, or just something happens that crushes the whole business. And there's nothing saying that couldn't happen with Tesla. There couldn't be. Again, in my eyes at this point, it's going to be pretty unlikely. I think you were gambling more or less 4 or 5 years ago with Tesla. Now you're going to be paying that real premium, getting it at the price it's at on that future speculation. But you have to understand, guys, when you're doing that, you're gambling. Whereas when you're buying a company like Starbucks, people might think buying a company like Starbucks is risky or gambling, but honestly, guys, go look at any Starbucks. It's insane how many people buy coffee there. You can see that you can feel a different risk tolerance, and you can look at their balance sheet. And when you look at the balance sheet, it's hard rock, guys. There's no better business than that. It's the lowest gamble you're going to make. Now, when family, I'm sure you might have family that comes up to you and says, look, why stock market is gambling. Why would you gamble? Like, I don't want to be in stock market investing. It was just gambling. The markets could crash at any time, and blah, 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 blah. The risk tolerance level, which is something that I bring up a lot, guys. If this is the risk tolerance level from 1 to 100 on just general life risk, okay? What is the 100% risk? Well, you could die, okay? Death. Death is the 100% risk, but it's the reality that we all face, whether we like it. If I can even get that to work. My spelling's horrible, sorry. So let's say the 100% risk spectrum is death. We're all going to die sooner or later. Unfortunately, it is the reality of life. No matter how much we invest, how much we think our future matters, we could get hit by a bus tomorrow. Something could fall on top of us. We could just fall and hit our head on the curb. Anything can kill you, which is the risk of life. Now, on the lowest spectrum of risk, we're talking about maybe just sitting here with a glass of water, hoping we don't choke and drown on it, or maybe just sleeping in your bed, somewhere where there's almost zero risk whatsoever, okay, guys? So let's just say sleeping. You're sleeping in your bed, you're less likely to do anything stupid, hurt yourself, or kill yourself. Now, in between comes everything to do with the stock market and your life in general, okay? In between the 1 in 100 risk level here that I've driven out for you is the simplicity of saying, I'm going to go to school and get an education. I'm going to take out a $50,000 loan and get a PhD in science, and I'm going to go and become a science lab professor, and this is what's going to happen in 10 years, or I'm going to become a lawyer. I'm going to spend 6 figures on going to school and getting my 5-year degree, and I'm going to hope that I get a job that's going to be paying me $150,000 a year. To me, that risk is closer to like the 80, 90 level. Like, you're not that you're getting close to death, but you're getting close to fucking your entire life up like a lot of people have. There are a lot of people that go to school. 50% of people that go to school and take out student loans don't end up going to get a job for what they went to school for. That, to me, is the most insane amount of gambling I've ever heard in my life. 1 in 2 of you that take out a student loan will not be doing the job you went to school for. Look it up. It is a fact of life today, guys. I can vouch it with all my friends that I know that went to school. Most of them blew it up their nose partying, and now they don't know what to do with their lives. It's just the fact that you have to understand that is more risky to me than, maybe working at McDonald's, saving up a few $1,000s, and buying Starbucks stock or buying McDonald's stock because you work there. That, to me, is less risky and probably falls somewhere closer to the 20-30 risk level, because the chances of that company going bankrupt are way less likely than you losing $100,000 in student loans you could never bankrupt from. That's the funnest thing about this little thing too, guys, is if a stock goes bankrupt, you only lose all of your money. If you fuck your education up, well, you can't even bankrupt on that money. It's crazy to me how people don't see that as risk. to me, guys, that's how life works. Life is just the fact that there's the safest of risk, and then there's I might be dying risk, okay? Everything else in between has to do with stock market and investing, and the only way to tell if you're truly gambling is how much are your emotions involved. When I bought Tesla stock, my emotions were 100% involved. I believe in what they're doing. I love Elon Musk. I just want to be a part of it. I don't care. Take my money. I'll pay the premium. I'm just not going to pay you $15,000 or $20,000 because I understand when I am investing in gambling / risk, high risk tolerance stocks, you don't put all of your money into it. You don't, when you're investing, guys, you put most of your money in the lowest risk investments, and then you slowly pile in little bits of high risk companies that you enjoy, because if those companies drop like Tesla has for me 30%, I'm only down $1,000. Might sound like a lot to you, but on a $113,000 portfolio, it's not even a rock in the pond. It barely makes a splash, guys. That's why you diversify, and that's why I hold some of the largest companies as my biggest positions, like Apple, Microsoft. They make up most of my portfolio. Very stable, grounded companies. Obviously, any one of them could go bust at any time. I doubt Apple's going to go bust because it's like the definition of the safest company you could ever buy, because they have enough money on the balance sheet to basically go bankrupt tomorrow and still pay their employees for the next 15, 20 years. I mean, you can see how looking at the balance sheet and doing it logically will put you in a comfort zone. When you start getting into that comfort zone, you're going to know you're not gambling anymore. You're going to know you're gambling when you don't know the future outlook, and you're relying on something that's going to be happening 5 or 10 years from now to make you the money that you're buying that premium for today. So it's something that you have to understand, guys. If it's logically based, it'll be like Starbucks. You'll go to Starbucks, you look at the balance sheet, you say, shit, this company makes a lot of money. Let me go look at their stores. Oh shit, every Starbucks I go to has a lineup out the door. You know what? Coffee seems to sell. It seems like they're going to keep growing. How about I buy into Starbucks? Boom, easy, right? And then you can just go through their balance sheet and see the income they make. Do they have more debt than liability? That's why I bought Starbucks over Dunkin' Donuts. Dunkin' Donuts is a great company, but the difference between Starbucks and Dunkin' Donuts is Starbucks has a positive balance sheet, which means if they had to liquidate all their real estate and everything they own today, they're going to be left with more money than they owe. That is how I like to buy companies, because it gives me another mitigated way against gambling and risk. But this has just been a really different video for me today, guys. I just wanted to rant and go on about this just before I head off to the city. I think it's very crucial that we all understand this, and it's something that I bring up a lot, especially now today in these crazy volatile moments, which is why I find comfort and solace in buying a dividend stock I trust, even if I overpaid for it, because I know for the next 10 or 20 years, people are still going to be lined up out those doors at Starbucks, and they're still going to be paying me. I'm not trying to tell you to buy Starbucks, guys. It's just a recent stock I bought, and I think it's a great example, and it's a simple example to understand your risk tolerance and gambling levels. So stay cool, guys. Stay awesome. I look forward to chatting to you real soon.